Let's talk about the market fundamentals and the way forward. Jigar Mistry, the co-founder of Boyne Capital, is now with us to talk more about the markets. Jigar, morning, and thanks so much for joining in. There are so many moving parts for the markets. There are geopolitical tensions on one hand. Domestically, the earnings season is behind us, but there is this big LIC IPO, the giant, which could suck out liquidity. How does an investor navigate through all this volatility, and what is the best way to position their portfolio?
Good morning, Reema. Thank you for inviting me again. I think the best way to do this is to break it down into what is some certain is what really available. The geopolitical situations that you discussed, people try to make some or the other meaning out of it, but these are civilizational scores being settled, right? What might be long term for an equity investor could be actually a blip in their calculation. So there's no point, as far as we stand in thinking about how Russia, Ukraine, NATO, US will eventually pan out, right? Flows is again one of those, if you break it down into two parts, the FI outflow is something which is a little more trickier to understand. Interest rate hikes happen and EM as an asset class becomes a little more risky, and therefore there is some amount of outflows. When we were last discussing on 31st of December, if you had asked me if they're going to withdraw about 1.5 crore in the next 3-4 months, I would have said probably not. But that is how it has actually panned out. So I would again put them in the unknowable category. And the third part is even the domestic flows, right? So if you look at a very long-term picture, then yes, you are at a very nascent stage. But there are 2 or 3 things I think which one needs to keep in mind. The first one is that the order on the F&O margins will likely hit us by 28th of February, which actually increases the cash margin requirement. I think that is one of the big things playing in the mind of a lot of players, and they're creating some amount of space, to deal with that. That we can probably deal with, right? If we were to push it down a month, 2 months in the future, then one of those issues can be handled. The second part is that, historically we have also seen a lot of, investors don't pay up on the capital gains in the quarterly installments. So a large amount of the, gains that they have made in this year, the tax on that will be payable in March 15. And then you will combine that with a large draw, 70,000 crores of LIC IPO. So that is, again, a little bit difficult, tricky in the domestic on the shorter end. Right, so let's break it down what we can do. Fundamentally, if there is a conflict, it impacts oil prices, that impacts current account deficit for India. But beyond that, I don't really see a huge fundamental issue in the economics of the Indian markets. EMs become risky, so flows might continue for slightly longer, and domestic situation doesn't get addressed. Now juxtapose that against to what we do know, right? If I put all of this into the unknowable category, what is knowable is, economy is in a very strong footing. After years of cleanup, you are probably looking at one of the finest fundamentals for the last 14, 15 years. The fiscal impulse was very solid. The monetary support continues despite hawkish stance elsewhere in the world. And corporate earnings have been reasonably resilient, right? So besides FMCG, I think a number of banks, a number of life insurance, I think companies, a number of consumption growth has been fairly strong. So what I would do is, I do remember that 31st, I said that there has not been a 7th consecutive year of gains, and we are already at the 6th one. So party pooper, as it might have sounded back then, the return expectations are now tapered. I think the median correction in stock prices is somewhere around 27-28%. And, people are no longer aggressively looking to buy the dip. I think those are all good signs. I would take a month, look at the liquidity conditions normalizing, and by which time, hopefully, and again, I'm saying hopefully, the geopolitical issues find some sort of a semblance. And then you can pick up on the fundamentals again. So I think expectations are tapered. It's a good time to reevaluate. Take a month. By 15th March, I think a lot of clarity further will emerge, but use that time to build a reasonably resilient portfolio.
Okay, Jigar, good time to reevaluate, but if at a time like this you have to put fresh money to play, then what perhaps seems like a safer option to you right now? Because like we pointed out, there is all of this volatility, and also like you said, there, it seems to be more reasonable now, the prices that we are seeing, so it could be a good time to put some fresh money to play as well, right?
Yes, good morning, Pavitra. Absolutely. I think, if you look at the entire trajectory, having drawdowns over, a period of time is par for the course. Unlike you are a stagnating economy, the markets do have an upward bias, and for drawdowns like this are very become uh, time to put good money at work as well, also because a lot of these businesses have corrected and they're now appearing where you don't have to make outlandish assumptions. So what I would avoid is something where you've seen the valuation and the interest rates being a fundamental part of valuations. We did discuss that before. This ultra high duration equity assets, the loss making equity assets today, in the hope that eventually they'll make a lot of money. If the interest rate go up by 2%, there you will likely see a drawdown on those name evaluation from.
All right, I think we've lost him and got him on a scratchy line, Jigar, but your point is well taken. What we'll do is